The IRS audits sole proprietorships a lot. In fact, they audit them more than anybody else, and there's a lot of good reasons for that. And I'm going to get into that and give you a few things that you can do to try to lower those odds. Anyway, this is Maurice Kempner. I'm an attorney, real estate broker, and business consultant. Welcome to True Legacy Wealth Media. One of the main reasons why sole proprietorships get audited is because of fraud. I remember talking to the guy who was over small business audits in the IRS, and he just told me about they had just a few days ago seized like a UPS truck full of Schedule C. So these are the schedule on the tax return, the 1040, where you put your sole proprietorship. And they were all fake, and they were made up in, I think it was Panama that he said. And so what had happened was is they had stolen all these identities of all these taxpayers in the United States, this criminal organization in Panama. And they shipped in, they did all these fake Schedule Cs with fake business losses. They sent them into the United States, file your tax return if your identity was stolen, put a fake business on there, get all the withholding that was withheld on your paycheck or all the estimated payments you made. They take all of that. And then you go to file your tax return and they say you already filed and all the money that you had sent in from your paycheck or your estimated payments has already been refunded to you, right? I've seen people have to deal with this kind of thing, and it's taken them up to 2 years to get their money. Eventually, you'll get it back, but you might be counting on that refund. See, so identity theft is a big problem in the IRS, and there's a lot of that going on with Schedule Cs. A lot of it's organized, and a lot of people they just make stuff up. I've seen all kinds of things where I've had people come in and they needed help. One of them was I'll just give you a couple of examples. A spouse made up a fake business on a tax return, gave it to her husband to sign. She said she prepared the tax return. He just signed it, didn't look at it. The refund came. It refunded all the withholding from his paycheck, and then she took it and put it in a separate account that he didn't know about. Later, they got divorced, and then the IRS audited him and came after him because of this business. And he, of course, he didn't know anything about it, and went downhill from there. So, anyway, eventually we got him out, but it was quite an ordeal. So those are the kind of things that go on with these Schedule Cs. Another thing is people just pile stuff on there. Lots and lots of mileage expenses. So like from real estate agents, I see this a lot. And so for these reasons, it's very lucrative for the IRS to audit these tax returns. Now, one of the other things to consider is that sole proprietorship income is taxed higher than capital, long-term capital gains, short-term capital gains, wages, income from S corporations, and so on. I mean, it's one of the highest tax rates out there, and it starts right from the beginning, and that's because of Social Security and Medicare tax, self-employment tax, another name for it. And so, since there's any deduction that they disallow, they can get a high percentage of that back against you because the tax rate is so high. In other words, if they disallow $100, they can get like $40, $50 back sometimes of that $100 that they disallowed. So they don't have to disallow as much. So there's a big payoff for the IRS, and so why wouldn't they audit? And I'm just going to tell you, when they do audit you, they're not just going to audit the year that your tax return is. They're going to go back 2 more years. So you're going to get audited for 3 years. If they find money there, they're going to audit you for 3 years and go back and get that money. So anyway, there's a big payoff for people when they do this kind of stuff because let's say, because even though the odds are high, I think it's around 5 to 6% chance of an audit with a sole proprietorship. Now those odds are higher depending on what's on your sole proprietorship, and that could be less too. So that's just the average, right? But let's just say you're some kind of fraudulent person filing a fraudulent tax return, whether it's a criminal organization or you're just somebody who's doing it yourself or whatever. So what's the risk? If you're this crime organization, it's very hard to catch them, especially if you're in another country. So there's not a lot of risk for them. For you, if you were to do stuff like that, people who are willing to do that kind of stuff, and I highly recommend against it. I mean, you go to prison for this kind of stuff. It's not a good idea. But what people think is they think, well, if it saves me $20,000 in income taxes, then and I do it, then I get the 20,000. If I get audited and I have to give back the 20,000, then I have to pay interest and penalties on that. So maybe that's $5,000 or so. So really, all I'm really risking is $5,000. If I have the 20,000 and I pay them by not filing this fake business return or I don't embellish it, then it's 100% that I'm out the 20,000. And so they roll the dice because they need the money. And the IRS knows people are doing this and they have ways to figure out what looks legitimate and what doesn't. The other thing is if you have the more income you have on your sole proprietorship, the more likely you're going to be audited because then there's more money on the table, right? They're going to want to go after this. A few years ago, I think it was around 10, 15 years ago, I used to keep up on this. I haven't for a while, but it was costing the IRS about $7,000 to do an in-person audit. Now, the $7,000, that's wages, rent, training, all these expenses that go into it, and they were scoring about 100% on average on their audits. So for them, if you got a Schedule C with a $2,000 loss and $4,000 of income, that's not as much of a risk, in my opinion, as other things. So if you've got a 40,000 of income and you've got a $30,000 loss, that's one they're going to be looking at. Okay, because there's more money on the table. Now, one of the things I know from research I've done on this is that there's a lot of indication that the IRS, if you claim 50% or less of your gross income from your sole proprietorship as a business expense, your chances of an audit go down dramatically. Okay, so let's say you make $100,000 and you have $50,000 in expenses. Well, your chances of an audit are quite a bit less. As soon as you go over that 50%, the chance of an audit go up quite a bit. So let's say you made $100,000 and you have $70,000 in expenses. Well, that's 70%. That's more than 50. Your chance of an audit go up a lot. And if you have big losses that cover W-2 and other income, that's another reason for a lot of auditing. So I'm just giving you that there as kind of a tip. Now, the other thing you might want to consider is should I change from being a sole proprietor to some other kind of entity? Now, if you go to a straight up LLC, either in a general partnership if you got partners or as a sole proprietorship, which is what we're talking about here. So you'd be a single member LLC if you just went to an LLC. There's no extra deductions you can get. There's really no way to save money on taxes by doing that. You're going to be taxed the same as a sole proprietorship, except that you'll have some extra deductions for the extra expenses you have of having an LLC. And it doesn't really lower your chances of an audit because the IRS considers an LLC not to exist for tax purposes. So if you have a single member LLC, they treat it just like it's a sole proprietorship. It goes on your tax return on the Schedule C as a sole proprietorship, and they don't even know or care that you even have it or that it even exists, right? Now, if you have partners, that's a whole different ball game, but that's not what we're talking about here. We're talking about sole proprietorships, right? Now, another thing you can do, if you do an LLC, is you can elect to have it taxed as an S corporation, or you can just form an S corporation. And there's pros and cons to this and things to think about, and that's for another video. But what happens then is your audit rate goes down significantly if you have an S corporation. S corporations aren't audited anywhere near the amount a Schedule C sole proprietorship is audited. Okay. And by paying yourself a wage for part of the income and taking the rest of the income as just regular income or dividend, whatever you want to call it, your Social Security and Medicare taxes can be reduced significantly. So reducing an audit and reducing your taxes might be one reason to have an S corporation instead of a sole proprietorship once you reach certain thresholds, because having these entities, or even if you just elect to be taxed like one, you've got extra expenses filing these more complex tax returns and maintaining things, and your LLC records with the state, forming all the expenses of forming it and maintaining it. And so there's kind of a breaking point as to where it becomes worthwhile and it doesn't. And it's different in different states. So different states have pretty substantial hefty fees, like Nevada and California have around $800 a year in fees for one of these entities that you don't have when you're just a sole proprietorship. So you got to make up for those fees and all these extra expenses if you do go to an S corporation. But anyway, that's how this works, and that's what's going on. And I hope it helps. And if it does, I hope that you'll like and subscribe, and appreciate you watching us. Talk to you later.